The stock market continues to hit record highs, an enormous feat achieved regularly thanks to extremely good earnings, fantastic sentiment, underlying growth prospects, and perfect fundamentals. Or maybe this is exclusively about the Fed printing a heck of a lot of money and companies simply going pedal to the metal, risk on behavior. And of course, that's exactly what it is. Investors know the game is rigged. They know something similar to the year 2000 will inevitably occur, but they have a job. That job requires them to generate alpha to make money. Even knowing the edge of the cliff approaches, the short and medium term goal never changes. Make money in this trading session and hope the Fed fixes everything tomorrow. You came here for the truth, so let me unveil that for you. Today I have a very important video and I wanted to discuss a few issues. The first thing is to discuss the Federal Reserve having some technical issues resulting in a delay in payments to people through their banks. This glitch should ultimately show the fragility of the current system. People are expecting their payments, they are expecting their checks. A lot of people live paycheck to paycheck. If that doesn't come into their account at that exact moment, they start to have all these bills that are automatically coming out and they've got big issues. I'm not necessarily suggesting that that's a good thing, but this is the world we live in today, where a lot of people are pushed right up to the edge, and that shows what's happening right now. A lot of people rely on every single dollar to come through at that exact moment, or they are going to go in overdraft, they're going to have serious problems with their debt, and we know the story there. Yield curve steepening and mirroring exactly what we've seen leading up to previous recessions, something that I talked about often here on the channel, of course. I wanted to give you an update on that. And then the World Bank warning about excessive debt loads on countries globally, not just in emerging markets, but of course in the developing world as well. I have a lot of information to get into, so let's begin. Direct deposits and other financial transactions were delayed on Thursday by a glitch at the Federal Reserve that has since been resolved. This wasn't necessarily a long period of time. It wasn't as if they were without their money for a few weeks, but we've seen other examples around the world for different reasons altogether, where the banks have been shut down or the amount of capital that you can actually remove from the banking system was restricted. These capital controls are implemented in different countries at different times for different reasons, but ultimately the effect is the same. Is that people who need their money can't get it. We saw Greece for a long period of time. They literally could not take more than, I think it was 50 euros a day out of the system. Now, what if you needed that money? Well, you had to get it from overseas. You had to get it from somewhere else because they were not going to allow you to take it out. These capital controls can ruin a lot of people. Then we also have the glitches. We have problems on the electronic systems. Any reason, whether it's actually a natural event, whether there's some sort of attack happening, people rely on a system that is ultimately very fragile. To me, that's worrisome, but don't worry, they've got you covered. According to Down Detector, you can see Capital One outage map. While there is some concentration on the east of the United States, it was basically all over the place. This was affecting so many different people, and they took to Twitter and other places to share their opinion with it. A lot of examples of that. The Federal Reserve is experiencing network issues causing certain transactions to be delayed. We're monitoring the situation closely in partnership with the Fed. As soon as they're resolved, we'll make sure everything's posted as quickly as possible. That was Capital One replying to some posts here on Twitter. But for any people who work in the financial industry, you know how frequent actually these problems occur, not necessarily with the Federal Reserve themselves, but for any number of reasons there are delays. People's accounts all the time in fund companies are mispriced and they have to go in and fix it at a later date. Now, you as an individual, you might not know what's going on, but these fund companies are always running operations in an overnight process. During this period of time, your account hopefully matches to what it actually should be. But there's nobody necessarily going in there and making sure that you have down to the penny exactly what you're supposed to. Everything should be in order on a day-to-day basis, but sometimes things go out of whack. As a result, there's supposed to be triggers and alarms set off to explain to those people who work in the technical departments that something is not right. Then they go in, they fix it up at a later date. But what if it takes a period of time? We've actually seen examples of this previously where people's accounts are screwed up for a period, and while, for the most part it gets resolved, how do you know what's really going on? And ultimately, bringing me back to the point I'm making initially on this tangent is that the system is certainly more fragile than we think. We put our money in with these companies hoping that we get it out out at the right time, the right amount, and everything is safe and sound. But sometimes that isn't the case. Alright, now I wanted to talk about what's happening with the 2 and the 10 year. This right here shows us what has happened over this period going back from 2018 up until the present. We saw how this actually inverted. Many people were worried about this initially, but as soon as it started to come up, everyone thought to themselves, well, the Federal Reserve has it under control. You don't have to worry anymore. That's largely been the case when you read the mainstream media. However, all it takes is a little bit of flipping back into the pages of history to understand that where we are at today is not good. In fact, we are falling right in line with what we have seen in previous recessions. Take a look at this here. Every single example of this shows you that we should be concerned. This chart goes back to 1980, and you can see example after example of the same exact behavior. We watch it as it happens, where this yield curve inversion takes place, and time again, a recession follows. We don't have to worry about necessarily the timing because we'll never be able to predict that. However, it shows us within this given range, we've got problems ahead. Just imagine this. The short-term debt is actually getting you more money than the long-term debt. You know that the financial system is messed up when that occurs. Now, we've already had the flip. We can already see that this has headed upward. You will note in the previous recessions, it's not when it dips below that yield curve inverts. No, not when that happens. It's actually when it comes back up that we have a recession. This could be a few months. This could be some cases 18 months. Who knows? That's just a range based on what we've had historically. But this here, 100% of the time is an accurate measure of what we will see. I just find it interesting that we are falling right into place right now on this very, very good indicator. Northman Trader brought this one up. It's just basically showing you what has happened with the 2 year and the 5 year, and then comparing that to the S&P 500 at the bottom. And I think it's interesting just to see these two because it happens time and time again. We see the peak that evolves, and ultimately, we know what happens afterwards. We see the yield curve inversion over and over again, and we are actually in that same territory today. The S&P 500 achieving new highs, and it's only a matter of time before that falls. Now, what could possibly make this fall? I mean, the Federal Reserve is there with their quantitative easing policy, and there's no possible way it can fall. There's just no way. But in previous instances, we have seen that the Federal Reserve was, of course, intervening in the markets at these times. Different reasons, different activities, different situations altogether. But ultimately, the Federal Reserve was present, the Federal Reserve was acting, and yet the markets still fell. This is a curious case, no doubt. Since the late 1980s, larger equity drawdowns tend to occur after the start of the curve steepening phases. This just shows you 2000, 2006, and 1989, comparing those. So of course, it all depends. The length of time, the situations are always a little bit different. The causes are never going to be the same, but we just take the stats and we make the best judgment for our personal finances and in what we're doing. Lags from curve inversions to recessions. This gives you the breakdown all the way back from the 60s up until the present. All that data is here. If you're interested, you can pause the video or look at the link in the description. To help the repo market, the Fed will inject approximately $500 billion over the next month. But have we been here before? In 2000, because of fears related to Y2K, they announced special funding, and guess where it went? Same situation happens all the time, of course. We see that the central banks react, they start to print money, they start to reduce interest rates, open market operations, they start to reduce any sort of restriction getting in the way of investors putting their money in, of businesses borrowing, of individuals getting loans, and so on. And it happens time and time again where we go too far. But they have to do this in a way in order to get this to continue, to extend that cycle. But in doing so, you actually create a worse crisis. This has been documented every single time. The fear and greed index has now accelerated to 91, and there's no stopping this thing. This thing could be at 120 for all I know, and people simply do not care. They're not going to trim the fat. They're not going to sell anything. Risk is certainly on the table. There's a couple charts here that I just wanted to mention very quickly and then move on. Deteriorating liquidity in the S&P futures preceded the fragility events of August 11th, 15th, and February 2018. Even as implied volatility remained muted, in 2018, markets experienced illiquidity spikes higher than any time since the global financial crisis, and illiquidity remains high relative to the level of volatility. This just gives you a breakdown, gives you an explanation of that. I wanted to move on quickly, but for those interested, definitely check this out. Realized volatility for the S&P 500 is at the low end of the range for the financial repression era. And on the right-hand side, from a long-term perspective, it's even more extraordinary. This breaks it all down for you in these Morgan Stanley charts. Hedge fund performance closely tracks fragility, not volatility. That's on the left-hand side. And then X-asset fragility is 50% of 2008 highs, even with volatility near the lows. Essentially, what we have is something that I've talked about many times before, how important the fragility of this system is. We never consider that because they're always talking about the VIX index. I need to be worried if the VIX is high, but the VIX index is such a joke. We know specifically that the Federal Reserve has said that we have a short position on volatility that is confirmed, that has been made public. Nobody batted an eye, nobody blinked, nobody cared. Look at the documents that were released about Afghanistan. Nobody gives a damn. They expanded the so-called defense. This is what we're talking about today, the insanity of this system. And meanwhile, people are yelling and screaming about stupidity all over the news I see every single day, and they tell me that my information is repetitive and BS. No way, I'm not accepting that garbage. And then last but not least, this just shows you what the World Bank had said, $188 trillion of debt. I don't even understand how we get to these levels anymore. It's ridiculous, but that's where we're at. They're sending out more warnings from the World Bank. The IMF is doing the same. The Biz is doing the same. All of these supranational organizations are suggesting that we have got some serious problems right here, and the cascading effects are going to be felt for a long time and hurt a lot of people. Governments need to get it under control. I don't necessarily like their solutions ever, but this is at least something that they point to, which is appreciated. The amount of debt is simply unable to pay back, and the inevitable crisis is going to be massive. That's all for this video. If you found it informative, hit the thumbs up button. When you hit the thumbs up button, you are supporting this channel, so I do appreciate that very much. If you want to make money, if you want to learn about business and e-commerce and everything in between, I created a free e-course just for my subscribers to help you out, more so with Amazon selling, but it is applicable to anybody who wants to learn about this in general, because I talk about brand building, I talk about something else, not just selling some cheap products. Definitely check it out because it's free, theamazongps.com. If you want to learn about the foundation, the history, the asset classes, how to reduce your debt, and everything in between, I created these two books to help everybody out, trying to give everyone that financial education that we were never taught through our school experience. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere, hang on. Have you seen this video? I think it's really important for you, and you definitely should check it out if you haven't already. Click on it and I will see you there.